They don't talk about it on the news. Most financial advisors won't bring it up. But quietly behind the scenes, a surprising shift is happening. Retirees are walking away from the very investments they once trusted with their future. Bonds, annuities, mutual funds, the so-called safe havens of retirement are being questioned, even abandoned. And it's not because these people are reckless or chasing risky bets. It's because they've started to realize something no one warned them about. The classic retirement playbook might be broken. For decades, retirees were told to play it safe. Shift from stocks into bonds. Lock in a steady annuity. Park money in mutual funds and trust the process. But today, many are discovering that what used to work doesn't anymore. Inflation isn't just a news headline, it's something they feel every time they go to the grocery store. Low interest rates aren't just a statistic. They're the reason their savings aren't generating enough to live on. And those secure investments they were promised would protect them, they're slowly turning into financial deadweight. The result? A growing number of retirees are pulling out. They're saying no to the traditional formulas. They're rethinking everything they were told about safety, growth, and retirement income. It's a quiet financial rebellion, and if you're not paying attention, you might miss what's really going on. In this video, we're going to break down the 3 classic investments retirees are ditching and exactly why you might want to think twice before following outdated advice. Because the truth is, what worked for your parents might be the very thing holding you back. Bonds were once the crown jewel of retirement portfolios. For decades, they represented everything retirees wanted: stability, predictability, and a reliable stream of income. Financial advisors swore by them. Entire retirement plans were built around the idea that bonds would cushion the ride when stocks got volatile. But now, something strange is happening. Retirees are quietly walking away. The truth is, bonds just aren't doing their job anymore. Interest rates have been painfully low for years. That means new bonds barely pay enough to keep up with rising living costs, let alone grow your wealth. Imagine locking away a chunk of your savings for 10 or even 20 years, only to earn pennies in return while inflation quietly chips away at your purchasing power. It's not just underwhelming, it's dangerous. Retirees are realizing that by staying loyal to bonds, they're slowly bleeding money. The safe investment is no longer safe when it can't even cover basic expenses. And it's not just about income. Many long-term bondholders have been blindsided by something they didn't expect. The value of their bonds can drop. When interest rates rise, the market value of older, low-yield bonds goes down. Some retirees who thought their money was protected have watched their portfolios shrink without warning. It's a reality few were prepared for. More and more people are realizing that bonds might be better suited for a different time, a time when interest rates were higher and inflation wasn't running hot. But today, they're starting to feel like a quiet trap. And for those depending on their savings to last 20 or 30 years, staying in that trap just isn't an option anymore. Annuities are often sold with one irresistible promise: guaranteed income for life. On paper, it sounds perfect. You hand over a lump sum, and in return, you get monthly payments that continue as long as you live. For retirees worried about outliving their savings, that kind of certainty feels like a lifeline. But what many don't realize until it's too late is that annuities come with strings attached, heavy ones. And once you're in, getting out is nearly impossible. The first red flag? Fees. Most people don't realize how much they're paying to keep those guarantees in place. Administrative fees, mortality charges, rider costs, layer after layer of expenses quietly eat away at your returns. Over time, those costs can turn what looked like a solid investment into something barely breaking even. And unlike other investments, annuities rarely offer transparency. You don't see the inner workings. You just see the checks, not the slow erosion behind them. Then there's the issue of flexibility or the lack of it. Once your money is in, it's not easy to get back. Some contracts lock you in for years, with stiff penalties if you try to withdraw early. Others limit how much you can take out annually, regardless of what life throws your way. And heaven forbid you need a large sum for a medical emergency, or unexpected expense. Many retirees find themselves stuck, watching their own money trickle back to them on someone else's terms. Worse, some never live long enough to collect what they put in. The insurance company wins, while their family gets little or nothing. It's a sobering realization. What was pitched as a financial safety net can end up feeling more like a financial prison. That's why a growing number of retirees are starting to ask hard questions before signing on the dotted line. Because in the search for certainty, they're discovering that annuities might offer less freedom and less value than they were led to believe. Mutual funds used to be the go-to choice for hands-off, diversified investing. You didn't need to pick individual stocks or worry about market timing. Just put your money into a professionally managed fund and let the experts handle the rest. That was the idea anyway. But for a growing number of retirees, that idea is starting to fall apart. Because behind the glossy brochures and reassuring charts lies a reality many don't discover until they're deep into retirement. Mutual funds can quietly cost you more than they give back. One of the biggest problems is fees, hidden, ongoing, and rarely discussed. Even seemingly small expense ratios can add up to thousands over time, especially when you're no longer contributing new money and just trying to stretch what you have. Then there are capital gains taxes, often triggered without your consent when fund managers shuffle the portfolio. You're left footing the bill, even if you never sold anything yourself. And for retirees living on a fixed income, that surprise tax hit can be brutal. But the deeper issue is performance. Many actively managed mutual funds simply don't outperform the market. In fact, most lag behind year after year while still charging premium fees. Retirees who rely on these funds for income are often shocked to learn their returns are inconsistent, unpredictable, and vulnerable to downturns. And when a market dips, as it always does, it's not just paper losses. It's your rent, your groceries, your peace of mind. Even index funds, which offer lower fees and broader exposure, come with a harsh truth. They rise and fall with the market. And if you're withdrawing income during a downturn, you're selling at a loss, something younger investors can ride out, but retirees can't always afford to. That's why more people are walking away from mutual funds altogether. Not because they hate the market, but because they're done paying for underperformance and unpredictability. They want something simpler, clearer, and more in their control. As retirees grow disillusioned with traditional investments, many are turning to something different, strategies that offer real, tangible cash flow without the false sense of security. This shift isn't about chasing wild gains or taking reckless risks. It's about finding income that actually works in today's unpredictable world. That's why more retirees are exploring alternative income sources, investments that offer flexibility, transparency, and most importantly, control. Dividend-paying stocks have become a favorite starting point. These aren't high-risk tech plays or speculative bets. They're often stable, blue-chip companies with a long history of paying shareholders consistent, growing dividends. Retirees like them because they provide regular income that can keep up with inflation, something bonds and annuities struggle to do. And unlike annuities, you can sell when you want. There's liquidity, there's choice. Then there are real estate investment trusts or REITs. These let retirees tap into the rental market without becoming landlords. You buy shares, collect rent-driven dividends, and enjoy exposure to a physical asset class that tends to hold up even when stocks wobble. For those looking to diversify, REITs offer a different flavor of stability, one tied to real-world property, not abstract market models. Some retirees are even going a step further, putting money into high-yield savings accounts, short-term T-bills, or peer-to-peer lending platforms. These aren't about massive returns. They're about smart, steady cash flow with minimal drama. In a world where trust in big institutions is fading, these smaller, more understandable tools are gaining ground. What ties all of this together isn't just numbers, it's mindset. These retirees aren't abandoning the market out of fear. They're doing it because they finally see through the illusion of one-size-fits-all safety. They're choosing income streams they can monitor, adjust, and understand. It's a quiet revolution. And for those paying attention, it's creating a new blueprint for retirement that's far more personal, adaptable, and resilient than the outdated advice of the past. For many retirees, the decision to abandon traditional investments isn't just financial, it's emotional. Because underneath the spreadsheets and retirement calculators is a deeper fear, losing control. It's not just about making money. It's about feeling secure, independent, and in charge of your own future. And when that feeling starts to slip away, when you're locked into rigid plans that don't adapt to real life, it does something to you. It makes you feel powerless. And that's what's driving so many people to rethink the safe strategies they were taught to trust. Retirees who once felt confident are now watching inflation quietly drain their purchasing power, while their portfolios barely move. They're told not to worry, that bonds will bounce back, that mutual funds are diversified, that annuities are the safest bet. But when every dollar feels tighter and medical costs keep rising, those reassurances start to sound hollow. What once felt like a fortress now feels like a cage, and it's leaving people more anxious than secure. There's also the emotional toll of uncertainty. Many retirees who followed the traditional plan now find themselves second-guessing their choices. They wonder why their monthly income doesn't stretch as far as promised, why their guaranteed plans come with so many restrictions, and why no one warned them how hard it would be to adjust. That quiet sense of betrayal isn't loud, but it lingers. And so, rather than accept the slow decline, many are making a different choice. They're stepping away from rigid plans and embracing flexibility. They're building portfolios that feel alive, ones they can understand, touch, and shape to fit their actual lives. Because for today's retirees, playing it too safe isn't just about missing out on growth. It's about losing the freedom they worked so hard to earn. And once they realize that, it becomes clear, the riskiest move is staying stuck in something that no longer serves them. What's quietly fueling this shift among retirees isn't just the investments themselves, it's the outdated advice behind them. For years, financial planning revolved around formulas that sounded foolproof. The famous 60-40 rule, 60% stocks, 40% bonds, was considered gospel. Advisors repeated the same strategies to every client nearing retirement, regardless of lifestyle, goals, or changing economic conditions. But here's the uncomfortable truth. Those rules were built for a world that no longer exists. And retirees are starting to notice. Decades ago, retirees lived shorter lives, interest rates were higher, and healthcare costs were lower. Bonds actually paid decent interest, and the stock market wasn't nearly as unpredictable. But today's retirees are facing something completely different. Longer lifespans, rising inflation, volatile markets, and a financial landscape full of uncertainty. And yet much of the advice they're given still treats retirement like it's 1985. The result? People are following plans that are completely misaligned with the reality they're living in. What's worse is how many advisors continue pushing these outdated models, often because it's easier or more profitable, or simply what they've always done. Meanwhile, retirees are left with rigid portfolios that can't flex with their needs. They're told to stay the course, even as their expenses rise and returns fall short. And when things go wrong, the blame shifts back to the retiree, as if they misunderstood the plan, rather than the plan being broken. That's why more people are starting to question everything. They're not just ditching old investments, they're stepping away from the old mindset. Because in today's world, staying loyal to traditional advice could cost you more than a few percentage points. It could cost you your freedom, your options, and your peace of mind. And that's a price many retirees are no longer willing to pay. Retirement was never supposed to feel like a trap. Yet, for so many people, that's exactly what the classic investment strategy has become: a rigid framework that promises safety, but often delivers stress, limitations, and slow erosion. That's why more retirees are waking up, looking beyond tradition, and making bold choices with their money. Not because they're chasing some risky dream, but because they finally understand that playing by outdated rules can leave them stuck in a game that no longer serves them. They're not abandoning security, they're redefining it. This quiet rebellion isn't about rejecting financial discipline. It's about demanding that the systems built to protect them actually work in the world they live in now, not the one that existed 30 years ago. They're asking smarter questions. Is this investment giving me freedom or taking it away? Am I truly in control or just following a script someone else wrote? And perhaps most importantly, do I even understand what I'm putting my money into, or am I blindly trusting the process? By walking away from bonds, annuities, and underperforming mutual funds, they're choosing flexibility, transparency, and income that actually fits their lifestyle. They're learning that true financial confidence doesn't come from locking your money up. It comes from knowing you can move, pivot, and adjust as life changes. This new retirement mindset isn't louder, flashier, or more aggressive. It's simply more honest. And if you're nearing retirement or already in it, maybe it's time to ask yourself, are you investing for the life you have today or for a version of retirement that doesn't exist anymore?